So Archie, my insurance agent is telling me I should buy an annuity with a part of my retirement portfolio. What do you think?
Well, Rob, that's interesting. Let's take a free look. I'm Archie Hoxton,
And I'm Rob Hoxton.
and this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast. We're your hosts, certified financial planners Archie Hoxton and Rob Hoxton. And we have an interesting topic today that may spur some controversy. A lot of people have strong feelings about this particular topic. We think it's an interesting topic and definitely worthwhile having an episode, maybe a couple episodes about. And it's annuities.
Right?
So
Annuities, the people who have the strongest feelings about them are the insurance agents who sell them.
Right,
for
right.
sure.
Definitely.
And they're not all bad. Some are great and some are not so great.
Yeah. And so our objective for today is to teach you a little bit about them and give you the tools to navigate whether or not that annuity is a worthwhile product to own and whether an annuity in general is right for you. So there's a lot to cover. We're going to try to keep it high level and simple. And I just want to start with the word annuity, right? So annuity, where that comes from, the definition of the word annuity is a stream of income, right, over a period of time. So that's kind of a guiding idea that you can use to think about what annuities are, right? So an annuity as a product, generally they have a feature that will pay you an income stream over a period of time, whether it's a stated amount of years or your
Think
life.
of it as like a personal pension,
Right.
sort of. That's the way they were originally invented to operate, right?
Yeah, they were invented to mitigate the risk of you outliving your money, right? So if you know you're going to get $1,000 a month for the rest of your life, well, you've mitigated the risk that your portfolio might run out of money. So that's where annuities kind of started, but they've grown a lot, and they're kind of more than that now. They also mitigate other kinds of risks. They mitigate investment risks, the risk of not having something to leave behind to your heirs. They can help you to deal with taxes.
How do they maybe touch a little bit? I know everybody's really interested always about how to kind of have your cake and eat it too, so to speak. I want market returns, but I want to limit the downside. So talk about your statement just now, Archie, about mitigating investment risk.
Yeah, there's a lot of ways that annuities allow you to mitigate investment risk. Some of them allow you to participate in market returns up to a point. They'll kind of cap you off, and then they'll also limit your downside. Maybe, you can't lose principal value in any given year, say. There's a million flavors of this, but that's one way that they can help you mitigate investment risk. So you've got the longevity risk, right? You've got an income payment that continues through the rest of your life or the rest of your spouse's life. You've got the investment risk piece, which they can find various ways to mitigate that.
Sometimes those products will have it's almost like the insurance company's doing two sets of books, and that sounds negative. Because I wanted to say it in such a way that would be a little scandalous, but really what's happening is you've got the performance of the underlying account on one set of books, and then you've got this other set of books, which is typically some sort of a guaranteed income rider.
Right.
There are things to look out for with that. I mean, if you boil it down quite often, in order to really get to benefit from the guarantees that come from that guaranteed income rider, oftentimes you actually have to annuitize the contract. Not always, but oftentimes you have to annuitize the contract, which then, sort of tilts the odds in the favor of the insurance company that they may not have to pay all of your money to you, because if you die when you've annuitized, you die young, then sometimes those payments stop. So they're amazingly complex.
Right.
And they often come with pretty substantial commissions. So you need to understand that whoever's recommending that you buy an annuity has usually a vested interest in your using that, unless it's a non-commission annuity, which,
Right.
from time to time we use in our practice. But when there's a commission associated with it, it can be, it can impair the objectivity of the person who's recommending it.
Yeah. Yeah. So that's why you have to sharpen your knowledge on annuities and go in armed with that knowledge so that you can be objective about it and you can sift through, what's a sales tactic and what is good risk management and good planning. And just so maybe to draw a little bit more clarity, I wanted to talk a little bit about the different types of annuities, broadly speaking. So you've got immediate annuities, which is where you take a chunk of money, you put it in the annuity, and it immediately starts that income stream. You've got deferred annuities, which I think are more common, where you put the money in and it then accumulates either with investments or some kind of interest rate or an interest crediting that is based on, say, the S&P 500. And so that breaks out into other categories. There's variable annuities. When you see that, just think this is invested in various sub-accounts, that just means it's invested in stocks, bonds, etc. And then you've got fixed annuities, which are you have a guaranteed interest rate that the insurance company is crediting to your account.
And it's usually based on the insurance company's own internal portfolio returns, right?
Right.
So yeah.
Right. And there's other kinds, right? So you've got fixed index annuities, which we touched on earlier. They may credit interest based on the performance of the S&P 500 or.
And interestingly, they sort of bring in and combine the traditional fixed annuity with aspects of the financial markets, right? So they may index to, say, the S&P 500, and to the buyer, it may seem like you're actually investing in a security. You're not, and it's important to understand that in order to sell you one of those annuities, those fixed indexed annuities, that person only needs an insurance license. They do not need a securities license. So there's not that additional level of licensing and continuing ed and oversight that comes from, say, one of the securities regulatory bodies like,
FINRA,
yeah,
SEC.
Right, exactly. So,
yeah, and that's a good point. Variable annuities, you do have to have the securities license because you're actually owning mutual funds, stocks, bonds in the annuity itself, in the sub-accounts.
Packaged to sub-accounts, right?
Right.
Yeah.
So I know that's a lot of information. To keep it simple, right? It's about investment risk management or managing the risk of running out of money through the guaranteed income streams. You got a bunch of different kinds. There's a thousand other flavors within that sort of framework of immediate or deferred, fixed or variable.
The deferred, it's important to note, Archie, as well, that one of the things that all of the deferred annuities have in common is they do get some preferential tax treatment, right? They're the taxes that would be paid on any given year because of interest, dividends, capital gains, whatever, are deferred.
Right.
And then when you receive that in the future, when you take money out, it's taxed not as a capital gain, but as ordinary income, which is not great. But you do get the tax deferral along the way.
Right. And there's two categories within that, right? You might have an annuity inside of an IRA or a 403B. That's pretty common, especially with teachers and so if in that case, then the full withdrawal is taxable as ordinary income. If it's in another kind of account, a taxable account, part of it will be, if it's annuitized, part of it will be ordinary income, part of it will be the return of your initial investment. You won't pay taxes on the return of your initial investment.
Good point. Yep.
So that's kind of the tax lay of the land. What should we watch out for, Rob, when we're shopping for annuities?
Yeah, I mean, it's kind of like, I hate to use the used car business as an example, but I've I buy used cars, lightly used cars, typically, and they're not all created equal.
Right.
So, something like Carfax makes it a lot better because you can see what the sort of the damage history is. But when you buy that car, is that funny smell that you smell when after you drive off the lot, is that because at some point it was in a flood, right? And it was under, 6 feet of salt water. So like annuities, that you really need to open up the hood, look underneath, and understand how they work, because some annuities can have really onerous expenses. I sat on Monday with a new client who had put $200,000 into a fixed index annuity 11 years ago. And it wasn't a particularly appropriate recommendation, but she can't get out of it without paying a surrender charge. And the surrender charge lasts for 13 years.
Wow.
If she'd surrendered it in year 1, she would have had a 10% penalty.
Mm-hmm.
In year 12, it's still 1.5%.
Mm.
So the devil is definitely in the details on these. And remember, like I said earlier, if it has a commission, whoever's recommending it may have a vested interest in that commission. So always, in our view, get with a certified financial planner. As a certified financial planner, they have a fiduciary duty to act in your best interest.
Right.
If they charge a commission, you get to know about that very clearly up front.
Right.
Right?
Right. Yeah. And a good fiduciary will always disclose that. There's other charges to look out for too. Any additional benefit that you're getting from the annuity, right? So if you have the ability to annuitize, right, you're going to see other charges. If you have the mortality and expense charge, for example, you're also going to see charges for the investments that are underlying. So if you have a variable annuity and you have sub-accounts, there are going to be expense ratios, which is just, a term that means what it costs to run the fund that's charged to you. So you've got that too. If you have, say, a guaranteed minimum withdrawal, that's going to be another charge. Sometimes a death benefit for your beneficiaries, that'll be another charge. And these are expressed as percentages that are charged against your cash value.
These can add up. You can be 3-4% in some cases.
Easily. And again, you've got the per year. Then you've got the surrender charge. So it's going to be locked up for a time. Some annuities, there is a surrender charge. It's just a difference between your cash value and the value of the annuity that would be used to calculate your income stream. That never reconnects. That will always be, so you will always take, a loss on your cash value. You won't get the accumulation value. We see that sometimes. There's market value adjustments, which are additional deductions.
Just when you thought you were past the surrender charge, out of nowhere comes the market value adjustment, right?
Right. And that can be a deduction based on changes in interest rates. So I mean, we're talking about negatives. There are annuities that don't have commissions, that don't have surrender charges, that some of them don't have market value adjustments. They can be very useful tools. You just have to make sure you get the right ones. Right.
And so that really comes down to making sure that whomever is making those recommendations has the same set of interests that you do.
Right.
So,
and you have to, because in that scenario, if they're taking the time to understand what you need and what's right for you, then they will either recommend or not recommend that product based on what you really need, and it will be agnostic to their own interests. So, because something like that might be right for you, If it's a really great product, it still might not be right for you.
Right.
You still might be better off in a traditional investment portfolio that's managed, it's diversified, it's balanced with risk that matches your goals and your risk tolerance. That still might be the better option, because you've got, even with a great annuity, a product that, again, is low cost, no commission, no surrender charge, you're still making trade-offs, right? Because you're still bringing in an insurance company to take some risk off of your plate. There's going to be some kind of trade-off. Maybe it's you don't get the same participation in market returns that you would.
So in summary, really, to use an annuity or not to use an annuity is really depends on your situation and what your goals are, right? So that's something that you'll want to dig into. Before we run out of time, I want to talk about one of our next episodes. We're going to talk about the only investment account in which you're able to get a triple tax benefit, a tax deduction, tax deferral, and tax-free withdrawals. They're called health savings accounts. I'm going to give you a little nugget right now. Did you know that under certain circumstances, any taxpayer can do an IRA rollover tax-free from their IRA to their health savings account and avoid paying taxes on that rolled over amount in the future? We'll dig into that more in a future episode.
Yeah. Stay tuned for that one. There's a lot to know before you do anything, but that's going to be a really good one. The HSA is one of the best kept secrets, and everyone should know about it. So, well, that's all for today. Thanks for tuning in. Remember to like and subscribe. Leave a comment. If you have a question, let us know. We'll reach out. We'll make an episode about it. So we'll see you next time. Thanks. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.